Hello, welcome to Asset TV. I'm Laura Keller. We are here in Toronto at the NEO Exchange, and we are joined today by Dan Stanley. He is a director at BMO ETFs. Dan, thanks so much for joining us today.
Thanks for having me.
And I would love to start just on your sort of how things are panning out. What is the outlook right now for interest rates in North America?
Yeah, so if you look back, 2017 was the low in the United States for the federal funds rate at 0.25%. Right now, it's sitting at about 2.25%. So that's 8 increases since 2017. So we're definitely in a rate increase cycle. And if you look at most analysts, most people think that that's headed up to the 4% range. So we're sort of halfway there. And that's similar to the Canadian environment. The bank rate in Canada is at 1.75%. And most analysts expect rates to continue to increase.
And do you see a divergence there in terms of policy between Canada and the US?
Canada is very much reliant on what the United States does. You never want to see too much of a divergence. At this point, rates are a little bit lower in Canada than they are in the United States.
And talk to me about mortgages. Of course, we're in a rising rate environment. Usually there are some negatives associated with mortgages, but talk to me about some of the positives.
Yes, and we've been hearing for the last decade how with central banks pumping liquidity into the system, that's been a tax on savers. At the end of the day, with rates starting to go back up again, that situation is starting to change. Savers, people who are who are relying on savings accounts, on GICs, who are relying on those for fixed income, are in a much better position now than they were certainly before.
Right, so borrowers might not like it as much, but the saver side, people who are investing in mortgages would.
Absolutely. There's sort of an offset to the borrowing, now the savers.
And how about as these interest rates rise, how can investors protect themselves in a rising rate environment?
Yeah, so it depends on where you are in the interest rate cycle. And as we were talking about before, if we're midway through the cycle, there's a lot of opportunities in the equity markets later in the cycle. So you still probably want to be in the equity markets at the end of the day. Volatility's gone up, so maybe you could use a low volatility strategy in the equity markets or a quality strategy in the equity markets. If you do feel you want to be in the bond markets, a couple of suggestions. One would be in the GICs. GICs are interesting now because rates have gone up. You can use a laddered portfolio approach, so you take advantage of rising rates. And importantly, as rates go up, GIC prices don't go down.
Okay.
If you do want a market traded instrument, something like ZST at BMO, it's an ultra short-term bond ETF. It has almost no duration, so almost no sensitivity to rising interest rates would be your option there.
So therefore, the low duration would be the help there.
Yeah, exactly. Mm-hmm. Again, if we're still midway through the interest rate cycle, you probably want to keep your exposure to duration to an absolute minimum.
Of course. Well, and there's a sell-off happening, possibly. Tell me about that. What do we define that as, and then how can investors really position themselves for whatever may come?
Yeah, any decline within sort of a negative 5% range, that's just noise. If you look at statistics, I think declines that are greater than minus 5% tend to be in the minus 13% range. Greater than minus 13, they tend to be minus 24. The ones that are greater than minus 24 average out at minus 34 historically. Those are the big ones. The big ones tend to happen when you have very high valuations, structural problems. How do you protect yourself against those at the end of the day? That's what we're talking about, asset allocation between bonds and stocks. So if you look at 2008, markets dropped 30%. 20-year treasury bonds went up 27% in 2008. So a 50-50 exposure to bonds and to equities, you would have had minimal exposure to that market decline. There is one big caveat to long-term treasury bonds, and that is that they have high duration. So you want to make sure your timing is right in that respect. Because if you get in too early, rates continue to rise, the value on those would fall. So a great way to do that might be a treasury bond ETF. BMO has ZTM and ZTL, midterm treasury bonds and long-term treasury bonds.
So that would essentially be a hedge to the timing question, because as we know, predicting it on the right angle is pretty difficult.
The timing, absolutely. That's the million-dollar question, is when do you do it? And that's when we start getting into questions about the yield curve, and the shape of the yield curve can certainly help there. The yield curve has flattened by about 25 basis points in 2018. So it's flat, it hasn't inverted. But when it inverts, that's sort of the time that you want to consider moving from stocks over to bonds.
Okay, so that's what investors should really put the fine point on.
Absolutely.
Mm-hmm. And then just turning to fears, inflation fears are happening all around us. What can the investor expect on that side of things?
Yeah, so inflation, of course, is bad for bonds. Anything that pays a fixed coupon, inflation is going to eat away at those payments. And what we're talking about here is looking at the long end of the yield curve, which is, rates are essentially determined by the supply and demand for bonds, which is determined by the expectations for inflations in the economy. And what's interesting right now is despite the Federal Reserve increasing short-term rates because of the expected growth in the economy, the long end of the curve, the bond market, it is actually pushing rates down or holding them steady. So we're seeing a flattening of that yield curve. It doesn't look like the bond market believes that there's going to be as much inflation and as much economic growth as the Federal Reserve might think there is.
Yes, that disconnect seems to happen every month when we get the minutes.
Absolutely, yeah.
And looking long term then, Dan, what are your expectations for interest rates? Do you think they keep rising along the same way, or how high do they get?
Yeah, so we're in a rising interest rate cycle. Again, I look at the United States Fed funds rate. 2017, it was at 0.25. It's increased 8 times since then. And most people expect it to go up to 4% range. So we're midway through that cycle. Now, at the end of the day, individuals are highly leveraged, corporations are highly leveraged, as are governments. So there is a cap to the high end of where rates can go, but there's no doubt that we're midway through a rate increase cycle, very likely, and rates will continue to go up from here.
So the investor should expect that.
Yeah, and position yourselves accordingly.
Right. Well, thanks so much for your insights today, Dan.
Thanks for having me.
Thank you.